Hello, folks, and welcome back to another episode of the Two Stewards Show.
I'm going to jump in and say my name is Brent.
Okay, he knows his name. It's a good start. And I'm Mark. Brent was pretty tired last time, but that was the afternoon. This is the morning. And hopefully we get through this with a minimum amount of yawns. Although, I don't know. We want to talk about the Phillips curve again, so we might be a little bit yawn-inducing.
Yeah, there's a lot of exciting things going on in the world. I don't know. So if you're not excited and living your life very excited, then maybe, just listen to this episode.
or maybe not. We'll see. But we wanted to do just a bit of a current events update. Do these once in a while and just kind of catch up on what's going on out there. And Brent, did you really want to lead off with the Phillips curve?
Well, it's broken, right? So we should talk about it, because if it's broken, we should try and fix it.
Are we going to fix it?
I don't know.
Okay. Well, this ties into Bank of Canada, interest rate announcements, all kinds of stuff. Right?
Yeah, all kinds of news items from the last, I think we did one of these 6 episodes ago or so. So, yeah, it's high time. But, yeah, the Phillips curve, we did an episode on that. So if people want to go back and listen to a little bit more of an in-depth explanation of what that is, you can listen to that episode. But for now, maybe we just kind of touch on what it is just quickly so that people have a little bit of understanding once we start jumping into some of the economic data we want to talk about today, how those pieces of data are interconnected or related or not.
Yeah.
So what you're going to make some sort of screwdriver joke already. I can see it.
Really? You can see that coming? Because it's coming. If you're looking for an explanation of the Phillips curve, that is when you look in my toolbox to grab a Phillips screwdriver, and they're all bent because I've used them to pry stuff open, right? Not their intended use, but all the Phillips is got a nice curve on it.
Using tools improperly.
Anything can be a hammer, Brent.
Yeah, so we're not hiring Mark for any renovations or anything like that.
Would not be well advised.
What is the actual Phillips curve when it comes to economics?
So anybody actually watching this, we'll see. I just pulled up the Phillips curve, the original paper.
It's a downward sloping curve, right? So
it's all downward.
See.
Yeah. So basically, it compares. I mean, originally it was the rate. Let me just read this: the rate of change of money wage rates as a percentage per year. So now commonly it's taken to mean inflation.
Yeah.
With the basic understanding that wage inflation leads to other inflation.
Yeah.
And that there's a general correspondence between inflation and unemployment. So generally speaking, when there is low inflation, there's high unemployment. And when there's high, and I know you complained about this. Why couldn't they just say employment? It's so confusing because you got to it's
when
it's
inflation's
backwards.
High, there's not low unemployment.
Yeah. So the idea is when there's high inflation, that means there's economic activity.
Right.
And originally, if we kept this to wage inflation,
and that makes more sense, right? That makes sense when inflation's high. Yeah, people are out there buying stuff, and there's a lot of demand.
Are doing stuff.
Yeah, and you want to
activity.
And there's activity and there's competition, right? Competition kind of drives up prices, right?
Yep.
I want these goods. No, I want to pay more. And that, so things are happening, things are going well, and inflation starts to rise.
Yeah. Okay. And then unemployment is low because if stuff's happening, we need more people to work.
Yeah.
And that's how she goes. So this has been kind of the mandate of central banks for many years, right? They have 2 things that they got to do. One is to manage inflation. The other one is to manage employment. And those are 2 kind of weird, disparate ideas, but the reason is because of the Phillips curve, right?
Yeah.
So what we've seen, though, is that the Phillips curve has it's decoupled or, it's broken.
Yeah.
So at some point when you're prying something with that screwdriver and it's not meant to do that, you're just going to break the screwdriver, right? So
that's a great analogy.
That's what's happened, right? Because of debt, government debt. The just extreme amount of government debt has changed this whole thing, because what's happening is we're seeing, in very simple terms, and not everybody would agree with this, especially if you're, a central banker or in the government, but debt is driving inflation. They print more money, they get more debt, and that creates inflation. So how do we get out of inflation? Well, print more money. Oh, wait a sec, but that creates more inflation.
Yeah.
Right? So that, like, the whole thing is broken.
You're kind of caught in this little conundrum, right? It's hard to get out of that cycle once you have to start printing money to pay for your debts. Now all of a sudden that triggers inflation again.
Yeah.
And it makes the problem worse.
Yeah, exactly. Because all that, the printing money means it's debt.
Yeah.
You're going into debt to print this money. So originally, what Mr. Phillips was talking about with wage inflation, that's like that curve is probably not broken, right? Wage inflation versus unemployment. But in general, the sort of the perversion of that thing, which now just means inflation, inflation is high, we've seen, and unemployment is also high.
Yeah.
Right. And so that means there's, you would think there's more economic activity, people should be working, but that's not the case.
Yeah, because inflation is not high because of economic activity. It's high because
it's not related to wage inflation. It's related to
debt.
Yeah. And so that
debt payments.
So, so a funny announcement.
Funny or
funny, sad, I guess.
Sad, funny.
From the States, right? They had GDP numbers come out, and they're like, it's like just about 5% year over year.
Right.
5% is like scalding hot. That's crazy.
Yeah.
As far as a yearly GDP number. So GDP is gross domestic production, and they're sort of pitching it as that's economic activity.
Like our country can produce this much economic value.
Right.
And
when GDP is the measure of, all economic activity in a country, but that includes government spending.
Right. So they don't tell you that.
Yeah. Nobody mentions that. Right. So when you look at, okay, maybe it's really high because most of that is government spending. It's not actual business activity. It's not trade. It's that. But they're anyways,
So what you're saying is government spending doesn't produce anything, or it shouldn't be on the GDP calculation?
I don't think it should. There's an argument that people can make that, no, of course it should, because if the government builds a bridge, you spend money to build that. Well,
everyone has jobs.
There's actual real benefits because, Joey Buttafuoco is building the bridge, right?
Yeah, and then he can ship all the potatoes across, and that's actually
the cannoli.
Good. Cannoli, yeah.
Cannoli,
okay.
yeah. We love our Italian friends, by the way, especially the cuisine. No, but the point is that there's economic activity. Construction workers are doing stuff, and they're spending money to the economy. So, you can't really ignore that because there's economic activity, there's velocity of money happening. I don't think it's a particularly good measure, though, because the government could do deficit spending on infrastructure, for example.
Yeah.
And
that's where they don't have the money to spend on the new bridge.
Yeah.
But they do it anyways.
Exactly. So there's stuff happening, but it's not real.
Yeah.
Like it's real, but it's it's not a good measure of like, hey, we're really healthy.
I just want to read this from Wikipedia, which is a very trusted source, I think. It says just about the Phillips curve and how it's broken. It's kind of funny because the end of the first paragraph says, a 2022 study found that the slope of the Phillips curve is small and was small even during the early 1980s. So that means like it's supposed to be this dynamic slope, and it's actually not, in fact, like this dramatic downward slope. It's actually a small curve. Nonetheless, the Phillips curve is still used by central banks in understanding and forecasting inflation. So I don't know if that's true, but I would have to go and dig all through the central bank's documents to see if they do, in fact, use the Phillips curve as a model for understanding inflation. But if that is the case, they're kind of using something that's broken to forecast something very important, which is inflation. That impacts a lot of their decisions. And we want to talk about those decisions too, about the interest rates and whatnot.
Well, the problem is, what else do they use?
Yeah.
Like, there's no other established, air quotes, model that they can use
Yeah.
I mean, there are, but not that they want to use, right? This is just like there's so much tied into this that who wants to be the guy to make that change?
Yeah.
Right? Not me. I'm not going to do it. I'll just work with the system we have and try and muddle our way through, right?
Yeah, we're at their mercy, right? As individuals, as real estate investors, not much we can do to force their hand on anything.
No, exactly. Don't fight the Fed. So, I was listening to George Gammon the other day, and he's the rebel capitalist.
Yeah,
he's got a podcast and a bunch of other stuff. But he made the comparison of, saying the U.S. economy and this whole GDP measurement thing. It's like somebody on life support, right?
I don't want to laugh about that, but
you laugh or cry.
I can see the
right. All their vitals are good,
right.
They can be like the model of health. Their oxygen levels are great. Everything
on
right?
paper when you look at the data.
Yeah, well, even if you just go check, look at the data. Everything is like incredible. You take that life support away, and all of a sudden, it's not.
Yeah.
So it's kind of the same thing with the GDP, right? You take away the life support, the massive spending, and things are not going to be okay. All of a sudden, that number changes. Right?
Yeah.
That data changes. And at some point, that life support's going to have to be taken away because they just won't be able to finance the debt.
Yeah, it's not sustainable anymore.
So, yeah, it's not very funny, Brent. You're right.
Oh, okay. Well, now that we've thoroughly scared everybody.
Doom and gloom into... So, okay, interest rates, we're talking Canada here. What did your buddy Tiff have to say?
Oh, he's quite the guy, that guy.
He's quite a fella.
Yeah. So recently, this is the last two rate announcements from the Bank of Canada. The bank held rates, right?
Yeah.
So I think this is... I'm kind of involved in this world now, so I check up on all these announcements regularly, but... I feel like more and more people are as well staying tuned to what's happening.
Especially people with mortgages.
Yeah. And a lot of people do have mortgages. But there is kind of this idea that, the Bank of Canada is holding rates, but, hey, we're going to raise them, or we're going to keep the option open to raise them in the future, right? Like eventually, something might happen and we're going to have to... inflation could be sticky, inflation could be sticking around. We got to get this down. So we're going to keep our options open. We might be raising rates in the future. Yeah. And a lot of that is kind of, virtue signaling, I want to say, or, not changing the tune entirely until the last week or earlier this week, actually. Tiff, there's an article here from the Globe and Mail. It says Macklem says Bank of Canada could cut rates before inflation reaches target. So they have this target, right, to get down to 2%. And this article is kind of saying that due to some comments he made, we don't need to wait until it's back down to 2% before we can cut rates.
Well, so part of the thing that has been sort of tacitly
that's changing his tune, right?
Part of what they have realized, or they've even said, the Fed and the Bank of Canada, is that they need to manage expectations. That's sort of a part of their job now, is manage people's expectations about inflation. Right. And that's based on the theory that how people think about inflation actually affects inflation. So if people think we're going into a recession, they're going to start not spending as much money. Yeah. And that can lead more quickly to the recession. Whether or not that's true, I don't know. But part of the game now is whenever they say anything, they have to say it very carefully. Yeah. And then
every word is charged with some sort of implied meaning. So
and then it's not all true either, because they're trying to manage expectations. So he might be, just keep that in mind as we're looking at this, what he says, because what he said hasn't always happened. Yeah. But they can kind of justify that, saying, well, we need to manage expectations.
So we can lie. We have a license to lie to everybody in the best interest of everybody, because, if we just told the truth, the whole economy would just go for a loop.
Very Machiavellian.
Yeah.
That's a kind of coffee, in case you're wondering.
Okay.
Next time you go to Starbucks, order a
Machiavellian.
a large Machiavelli. See what they say.
Don't they ask for your name? Like, what's your name?
Nicolo.
Okay. I feel like there's some more reading material about that reference there. But then they start introducing language like, we have not ruled out further interest rate hikes, right? So they would say that almost, like you said, to keep the expectations like, oh, you know what? I was going to do this activity, but now because he said that, I'm just going to wait another couple months, right?
Yeah.
Like I think part of their fear is that this activity in the real estate market, like speculative activity or overbidding on houses and all of this stuff would return quite quickly if they just said, you know what, we're putting a pause on rates. We see things starting to weaken in the system. And then all of a sudden everyone's like, okay, well, maybe we can afford it. So we're going to go in and try and start looking for houses again.
Yeah.
So it plays with people's confidence levels, right?
Yeah. Yeah, absolutely.
So, and then another thing on top of that, so there's another article from TIFF, upcoming mortgage renewals, part of why the Bank of Canada held rate at 5%. So this is something we have a little bit more data on as well.
Yeah.
But yeah, there's a big segment of mortgages that are like every 5 years, obviously, or every 3 years, whatever your mortgage term is, when that comes to renewal, for people who've locked in at fixed rates, they could be facing a massive uptick, right? So he's looking at this as the governor of the Bank of Canada saying, well, that's a big reason why we're not going to raise rates, because we don't want people to renew at a much higher rate. So,
well, because we've heard lots of stories of maybe this is not out there in the media, but certainly being in the industry, we hear this stuff all the time, right? All these renewals that are happening. And I went through it myself. I don't know if you recently renewed. Did you? Yeah. So we've been through it. A lot of people have been through it, and like
utterly painful.
What's that?
It's utterly painful.
If you're a cow, yeah. Utterly painful. Dairy farmers finding it utterly painful. That's a good headline. No, but everybody's paying a lot more once they got their renewal, right? So the first signs were people on the variable rate mortgages saw their terms expanding till they had a trigger rate, and then they had to either, come up with some cash or increase their monthly payments. And that was a lot of investors that we know and talk to, right? But now, like, more and more mortgages are being renewed because if we're mostly 5-year terms in Canada, as you pointed out earlier, because the stat was what, 60% of
60% of mortgages renewing in a 3-year period.
Like, whoa, big deal. And then I think your friend pointed out, like, almost every mortgage is a 5-year term, so of course it would be 60% over the next 3 years, 20% a year. But the point is, like, we've sort of had that first tranche of mortgages that have renewed. And like it's painful, right?
There's a little bit of pain. Mortgage
payments have gone up, 50% on average or something like that. Yeah. So that's like, those are some big numbers.
Yeah.
And
as Robert Breedlove says, pain is information.
Yeah, exactly. I got a graphic here somewhere. Oops, that's you. This is me. So this is a report from. Oh, I can't remember what. It's from StatsCan, anyway. So Mikhail Skuterud, he's an economics professor, and he's on Twitter. And again, if you're listening, you can't see this, but he's a good guy to follow, anyways. If you like nerding out about some of this stuff. So this is from today, actually, so November 3rd. And so this is the number of households in Southern Ontario most likely to report difficulty meeting financial needs. So we've got difficult and very difficult as the two things, two measurements.
Two survey responses or whatever.
Yeah, so just over in St. Catharines, Niagara, just over 40% of households reported difficulty meeting their financial needs as either difficult or very difficult. So, and then it goes sort of down across Canada, but the average of Canada is about 35% or so. And so, I think we would see that number go up as mortgage renewals keep happening at these higher rates. So that's just that's going to affect one, homeowners, obviously, because they don't have much choice. And then two, investors, if they can pass on the rent increases to their tenants, they're going to, if it's not rent controlled.
Yeah.
So renters are going to feel that pain across a lot of Canada. And then in rent controlled markets like BC and Ontario, there's going to be a lot of pain and something's going to have to give. People are going to be selling homes or
displacing tenants as well, right?
Maybe just moving in, selling their house and moving into the rental property, just so that they're not negative cash flow. So
and that's kind of a hypothetical thing, right? Like it looks like that will happen, unless our all-knowing, or not all-knowing, but our all-wise,
the man behind
fearless leaders decide to do something about it, right? Or and what can they do? Well, like this article says, right? The mortgage renewals that are coming up are big consideration in the back of their head. They're looking at, well, okay, if this is going to happen in a big wave over the next 2-3 years, and everybody's going to be feeling the pain, is that something they think is good for Canada? Is that something they want to avoid for political reasons because they want to look good? These kind of things are also political opportunities, right? It's like, hey, can I introduce something to ease everyone's pain and look like a hero? And one of those things might be longer amortizations, right?
Yeah, so that's a government thing, right? So this is Bank of Canada you're talking about, Tiff Macklem, saying that, we're probably not going to increase rates because of this mortgage pain. And like, we'll get to the longer AMs in a sec, but you got to wonder, like, that's not really his purview, right? Like, he's got to manage inflation. So could that increase in, like, I don't think higher mortgage payments are not going to increase inflation. They might decrease it because there's less money to spend on other stuff other than homes.
Yeah.
So Bank of Canada is supposed to be independent.
Yeah.
Right?
Keep the rates high. Everyone will be paying all their money on mortgage payments. They won't be able to afford anything else, so they won't.
Well, fiscally speaking, that might be a responsible thing to do. Keep rates high so that if you believe that there's too much speculation and whatever else.
It's funny because usually the responsible thing to do is probably oftentimes the painful thing to do.
Yeah, austerity, right? Yeah. Feel the pain and we'll deal with it. We'll get through it. And
that's how you work out too, right? Yeah. Feel the pain.
I'm not sure if that's how people do it, but that's what I've heard.
If you want to build muscle, I think you need to exert yourself and suffer in some way to tear your muscles, and then they repair themselves. And I don't know all of this stuff, but
we'll do a separate podcast on the whole theory of micro tears and all that stuff.
Okay.
But yeah, that not likely that the Bank of Canada wants to do that, though, right?
No.
They also, I don't know, they don't want to be the bad guy.
No.
So, is this really his responsibility, worrying about mortgage renewals and mortgage rates and stuff, right? It's not, again, does it have to do with employment or inflation? Not really. So why is he worrying about that? And so my answer would be political interference.
Right.
Right? Because this has been a newsworthy item, and certainly the Prime Minister has changed his tune from saying, well, housing isn't a federal responsibility, so like get off my back, to housing is like something that we're very interested in, and we're going to do this and that to fix this whole mess, right? Because they're sliding in the polls. So we got to do something. So you could only imagine that there's pressure being placed on the Bank of Canada by the government to do something, or to, in this case, not to do something. Anyways, that's my little rant about political independence. What were you saying about longer amortizations?
Well, I was just saying that is one one point of relief, right? So when payments are higher and interest rates are higher, and there's a big wave of mortgages coming to renew, and people are expecting, I'm going to have to double my payment. One way to relieve that pain or pressure or fear that people might have, and gain some time in terms of the stability of the system, but also gain some political popularity, is let's make if we can't reduce the rates, we don't have control over that because of other reasons, well, let's lengthen the amortization of people's loans, and that will reduce the payment. the monthly payment. So, they're not like forgiving debt, or you're still going to pay for this house or the debt over time.
You're going to pay.
Oh, yeah. But now you're going to pay over a much longer period of time. So it's going to be a lower monthly payment. So that might be some relief, right? And people might welcome that.
Well, so Chrystia Freeland said that. I can't remember exactly what she said, but basically we expect
I
banks.
saw her walking around my neighborhood the other day on Halloween, or was someone dressed up as her?
Oh, okay. Yeah, doubt it'd be her. But she said we
She's
expect. Yeah, that would be a scary costume. Her as PM, that would be very scary.
Yeah.
She said that we expect Canadian banks to work with consumers and do everything they can to blah, blah, blah. I was like, what does that mean?
To ensure that the consumers don't default and cause economic havoc.
Yeah, I mean, she didn't go, say all that, but basically, like, we expect banks to work with consumers. So, like, what does that mean?
Yeah.
Like, what can they do? They're not going to just forget, like, as you said, they're not going to forgive payments.
Yeah.
Right? They can't reduce interest rates.
They don't have the control. Yeah.
I have heard that. I thought there was some talk about some banks dropping interest rates because, again, you've got variable mortgages based on the government overnight lending rate, but then fixed mortgages are based on the bond market. So if the bond market is dropping, that would bond prices are dropping, that would give banks the leniency to also drop mortgage rates.
Yeah, but it's not directly in their control. Like, they're not influencing the bond market, making it go down.
No, they're at the mercy of either the bond market or the government or Bank of Canada, with the overnight rate. So, what's left, right? Amortizations. And we've been talking about this for a while, saying, like, expect longer amortizations. Like, that would be and we didn't, this wasn't our idea, so we can't take all that credit for it. But we've seen with variable rate mortgages anyways, that the amortizations have been increasing. Right, that's one thing that the banks have already been doing.
We got this one here from October 23 by Josh. What's the mortgagesforless.ca? So 40-year.
That's the byline, Josh?
By Josh, yeah.
Okay.
Kudos to Josh for putting this together. Equitable Bank. So this is a bank in Canada.
Seventh largest in Canada.
Seventh?
Yeah, I've never heard of them, but they're the seventh largest.
Yeah, so... they are to offer 40-year amortizations, and they're going to launch this over the coming months. And so just a bit of history. In Canada, we had 40-year amortizations in 2006, and then there were some concerns around risks in the housing market, increasing household debt levels, because obviously if you can take on a longer amortization, you can take on a big debt. Or like for the same payment, you can take on a bigger debt, or you could take on the same amount of debt and then go get debts elsewhere because your payments are lower, right? Yeah. So your money seems to go further, but essentially you're just building up your household debt.
Well, and anybody doing lending looks at your debt ratio. So they're not looking at the terms of your debt. They're just looking at how much you're spending. So if you want to go buy a car, maybe you can get another car or a better car if your mortgage payments are lower.
Yeah. And we've done that too as investors. Like we had a property that we were paying extra every month, right? For years and years. And then, we said, we can't qualify for another loan unless we reduce our mortgage payments to the minimum monthly obligation, right? So that kind of came in handy because sometimes you can even bump out your amortization and they'll let you kind of gain a bit of extra time, and then your payments will go down. And the effect of that on your overall financing, especially if you have one or two mortgages, right?
Yeah.
Now all of a sudden the banks look at you and they say, hey, this guy actually can afford more debt. And in the context of a real estate investor or somebody who's looking to invest, that's actually like, now I can buy an asset with that debt.
Yeah,
right?
it's beneficial.
So it's beneficial. But if it's just talking about the broader Canadian population and people who just maybe have their own house, but then will use that extra debt for whatever other pleasures they want to indulge themselves in.
Like groceries,
like a steak, or driving to work, or no, I would assume they would maybe splurge on something that they couldn't otherwise afford, right? So they're so just going through the history of what happened with these 40-year amortizations. Then the Canadian government, through CMHC, they began to tighten the mortgage rules. So they said, you know what, debt's getting too high. We're kind of concerned about this. Let's tighten the mortgage rules a bit. So
that's only for insured mortgages, not for uninsured.
So they made changes by 2008. The maximum period was 35 years. And then in 2012, it was reduced to 25 years. And that's with insured.
Yeah.
Right.
Through CMHC.
Yeah. Through CMHC.
So if it's not insured.
Yeah. Then you need 20% down if it's uninsured. So for a lot of people who are buying their second or third or whatever, a rental property, it would not be insured because you don't have that option.
But yeah, we've seen like people, especially again on the variable rate mortgages, they've had their amortizations extended by the bank just automatically because the bank's like, okay, we're not going to increase your payments, but we're going to increase the term of your loan.
Yeah.
To 40, 50, 60, I think 96 years was
96 years.
One that we saw. So, and yeah, I mean, the banks in this case, they're laughing, right?
Yeah.
Because now they've taken a product where they're going to earn interest for 40 years.
Yeah.
And now they're going to earn interest for, 60 or sorry, maybe it was 30 or 25 years. Now they're increasing that. They don't have to do any marketing to get another loan they don't have to do anything else. They're just increasing that and keeping interest payments for another 15 or 20 or 30 years. So that's awesome for them, right? And I have no doubt they would not hesitate to extend amortizations, especially for, well, I guess it doesn't matter whether it's your primary home, because people are going to do everything they can to pay the mortgage on their primary home.
Yeah, they don't want to be displaced. They don't want to have to,
Yeah, but then even for investors, like for an investor, if I can stretch out that loan to infinity, I'll do that. Because all I'm concerned about is that monthly flow.
Yeah.
I'm not worried about ever paying that off because I got tax advantages and stuff like that, right? So, extend these amortizations. So I think we're, these guys, Equitable is doing 40 year.
Yeah.
At like 9. So they're actually not doing the lending, right?
Okay.
You read the fine print. They're doing it through a partner.
Yeah.
And I don't know who the partner is, but I think it's around 9% or something is going to be the interest rate.
Yeah,
so
they anticipate the rates to hover around the 9% mark.
Yeah, so they're not doing this out of the goodness of their heart.
No,
right? There's an opportunity, and they're going to.
But even that, it's a topic of conversation, and it's one of the things they're considering that they've previously deemed to be of concern because it's causing higher debt levels in houses. I guess they kind of resign themselves. You know what? Everybody's got a lot of debt anyways, so we're just gonna, facilitate more debt for everybody by making the payments lower.
And I think it's the tip of the iceberg, right? I think you're going to see the other 6 banks do something similar.
Yeah, want to get in on it,
and probably longer, right?
Like 50 years.
Yeah. This will be a test case, but I mean, the worse things get, the government doesn't want to see a lot of their voting block, right? Homeowners, I think, in general, tend to vote more than renters.
Yeah.
So they're not going to want to see them displaced, right? Because it doesn't matter what government is in power. If I lose my home, and if the Liberals are in power, I'm not going to vote for them. If I lose my home and the Conservatives are in power, I'm not going to vote for them.
Yeah.
Right? People are going to lash out at whoever's there.
So either rates could come down or amortizations could extend, and those both would provide relief to households and investors, to everybody who has a mortgage or has debt. And then it's just a matter of which one will happen and to what extent, and who will use them for political expediency or gain.
Yeah, and how much pressure can the federal government exert on the Bank of Canada?
They shouldn't exert none.
They should. They shouldn't exert none.
Should exert none.
Should exert none. Yeah, they shouldn't exert none. far as I'm concerned.
Inflation and employment.
Now, they shouldn't, but I think like they do.
Yeah.
I don't know. I just think that's a fact. So we'll see how resilient the Bank of Canada is.
But this like wave of upcoming mortgage renewals makes for a great headline, right? Because it is kind of like, whoa, this tidal wave is going to sweep right over everybody, and you can't stop it because it's just a matter of time before your mortgage, which is a 5-year term, renews.
Yeah.
Right?
And it's much easier for policymakers to take action if you have like a tidal wave instead of just like mortgage renewals are continuing as
1%.
They have every year at 20% per year or whatever the number is, right? And there could be some economic consequences. Like 60% of mortgages renewing over the next 3 years. Homeowners are going to be underwater. Like
100% of mortgages are renewing in the next 5 years.
Yeah, exactly. Right? What? When did this happen?
Yeah. What country are we in?
So, and I mean, I don't know. Maybe there's other things on the table, right? In the States, you actually have 30-year terms, generally speaking.
Yeah.
Not 5-year terms. So
and when you say term, you mean you lock in your rate for 30 years.
That's
and it
right.
doesn't renew in 5 years.
That's right. So yeah, you get terms and amortization.
Well, just to chat about that quickly for a second, because that impacts their housing market a lot. It's a lot different than here, because why would somebody sell a house in the States if they have a 30-year mortgage at 3% or 3.5%?
Yeah, so you're seeing a lot of people trying to use what's called subject to financing. So that means I'm going to buy your house, Brent, subject to the option or the fact that you are going to give me your mortgage, that you can port your mortgage to me, essentially.
Yeah, so you're selling the house and the mortgage.
Exactly.
Because the mortgage is really valuable today.
Yeah, the mortgage has more value than the house sometimes, right? Depending on it. So I'm not super familiar, but I haven't really seen that in Canada as a thing. It's only when I started looking at the U.S. market I've heard of this.
The mortgages are transferable.
Yeah, because I don't think you can do that here.
No.
No, but you can make that. And I don't know. There's a whole little niche of people who will show you how to do this.
Yeah, it's not as important to do that here either, because in 5 years it renews anyway. So it's why go through the hassle and all that?
Yeah, that's
I get to
have a good point
3
there.
years of someone's cheap mortgage rate.
Yeah, but there's all kinds of tips and tricks to do that, and be like, the bank has no right to actually say no. I don't know if that's true, but anyways, that's an interesting thing, right? So could we see longer, not just amortizations, but longer mortgage terms?
Yeah,
that could be. I think nothing is off the table in an election year.
Yeah.
So
and that's next year.
That's next year
in Canada.
And as we know, 20% of mortgages in Canada will renew next year.
Okay, what else do we want to get into really quick?
Okay, I wanted to talk about Japan quickly.
Oh, great.
And why are we talking about all this stuff? Because it affects real estate, it affects the housing market. So Japan is an interesting sort of case study for what we're talking about. Yeah. Because back in the 90s,
that's that white flag with the red dot on it.
Yeah, that's right. Okay. Yeah. Pearl Harbor, sushi, snow monkeys, Mount Fuji.
Yeah.
That's about all I know about Japan.
Some good snowboarding in Japan.
That's what I hear.
Yeah.
The very interesting in Japan. So in the 90s, their economy was on fire. So they're now the 4th largest economy
in the world.
In the world. And this is not a big country, right? And this is not a country with a lot of natural resources, right?
Yeah.
They're a bunch of rocky islands, basically.
Yeah.
So not tons of natural resources, but and they were they had a rough go of it in the 40s, right after World War II. Right, they were a power, and then the war happened, and anyways, they rebuilt, and they were a real powerhouse in the 80s, and going into the 90s, they had a lot of real estate speculation. And this is a very simplified version I'm giving here, but one of the things that they did in response to some of this stuff, especially the real estate market, was to raise interest rates. and just to sort of tamp this speculation, right? So basically, they killed the economy, for lack of a better word.
Mark's laughing about that.
And
but they're still the fourth largest with a dead economy.
They were bigger.
Okay.
And like China has risen considerably since then, right?
Yeah.
But so they've had like decades of stagnant growth, and the government has engaged in yield curve control.
What does that mean exactly?
Oh, do we have to get into yield curve control?
Well, so just what are they trying to do with that? Like if
they're trying to control interest rates and keep inflation low.
Right.
So basically, if we let's talk about the yield curve real quick. Like, see, I don't know if I got do I have a picture somewhere?
Well, you said they had stagnant growth, which I'm assuming just means they were stagnant. They didn't have any growth.
Yeah, that's that's a good one.
No growth, so they didn't grow.
Yeah, so yield curve. So the yield curve is basically if you look at all the bonds that the government is selling over a yearly sort of spectrum. So if we talk about U.S. T-bills, for example, they will sell shorter durations, but let's say year being the smallest major one, and then 3 years, then 5 years, then 10 years, and 30 years. Those are sort of all the major denominations that they will sell bonds in. So if you picture from 1 to 30 as the bottom line of a graph, and then the interest rate would be the other axis on the graph, generally speaking, you get there's a curve, right?
Yeah.
So your typical yield curve would be lower at the bottom end and higher at the top end.
So the shorter duration bonds that they're selling
have a lower interest rate.
Right.
Right? Because you're putting your money in, you're going to get some money, but you get it back pretty quickly.
Right.
Whereas if I'm investing
the risk
for 30,
is lower.
The risk is lower. If I'm investing for 30
so you're making
years,
a lower percentage return.
Yeah.
Yeah. So that makes a lot of sense.
Yeah. And then, so if I invest for 30 years, that's a long time. And who knows what can happen in 30 years.
Yeah. So you better pay me a higher interest rate.
Exactly. So that's the basic theory. I mean, really, bonds, once they're bought, they are traded now on the market, and nobody actually ever would hold a U.S. Treasury for 30 years.
Yeah.
But that's like, whatever. We can get into that another
so
time.
how does this relate to Japan?
So yield curve control generally means, so they're trying to control that curve, right?
Yeah.
So usually what that means is they're targeting the long end of the curve.
Yeah.
To sort of flatten out the curve and to control economic activity. So like really what that means is they're going to buy as many long duration bonds as they can to keep that price low. They don't want that price getting out of hand. They don't want that going up and the curve to steepen. They want to keep it low. So the minute somebody starts selling a lot of bonds at a higher premium on the second market, they're going to buy them all.
Right.
And just like nobody else can buy them, and just sort of control it that way, right? So quantitative easing is sort of the other thing that you could do not in relation to the yield curve, but in the bond market in general, and that's when they just buy everything.
Yeah.
So right, which is what they have done.
Sounds so smart.
Yeah, well, yeah. Instead of we're just going to buy everything, no, we're going to call it quantitative easing.
Yeah.
And that's so much more sophisticated, right? Like, nah, you're just buying everything, guys. Yield curve control, they're just buying at the long end.
Yeah.
So anyways, Japan has done that in order to keep inflation low, and they've targeted 2% inflation, but just to control everything. So anyways, they've had
and that affects the economy. That affects people's outlook of the economy and expectations.
Yeah.
It's kind of like we were talking about earlier, right?
Yep.
They expect... Yeah, if all of a sudden they saw that thing rise, the long end of the curve, they would have a totally different expectation than if it was just kind of stable, what they would expect, right?
Yeah. So, they want what they're trying to do is kill deflation, right? So they're buying stuff as well. If it's going down, they're going to snap those up so that the longer duration bonds don't sell for less than they should, right? So they'll control sort of the interest rate at the front end, but then also control the back end, right? So they've been battling deflation caused by this massive interest rate spike. Like, where else have we heard this, right? So we're not in that quandary right now. But this is sort of where Japan's been for decades,
And
right?
the fourth largest economy.
Yeah. And so one thing that they've done is they've bought a lot of U.S. bonds as well. And but now they're having some issues with the yen, that's their currency, starting to devalue. So they're selling U.S. bonds in favor of the yen. So one thing a central bank can do is sell foreign treasuries. So like you'd sell your strongest one to get the most value and then buy yen, again, to sort of control that market, to not let it free fall. Like we're going to buy it for a certain price. And so if you're going to sell your yen for, let's say, I think it's like 150 yen to $1 US right now, we'll buy it at that price so that you're not tempted to just like, oh, I got to get rid of these, so I'll sell them for 200 to 1, right?
Yeah. Yeah.
Like I will buy them for 150 to 1 or 140 to 1.
Yeah.
And that's kind of what they're doing with we're doing with their bonds as well, right? So you're controlling it on the high from going up, but also from dropping. We'll be a guaranteed buyer, so that stabilizes the market, right?
Right.
And sort of increases or decreases the risk of deflation. So there's not a panic. So if you're holding those, you can know I'm going to hold these, and they're going to buy. If I ever want to sell it, they're going to buy it.
Yeah.
So I don't have to worry about getting panic selling, basically.
Yeah.
So anyways, a little bit of panic selling with the yen. They're selling a lot of U.S. treasuries. So that's going to affect the U.S. dollar as well. But yeah, I don't know where I was going with all that, but that's just it's something that's happening, and most people don't pay attention to this, even like economists, because like Japan, whatever, right? But again, fourth largest treasury or fourth largest economy in the world, huge holder. I can't remember, but they're in the top 3, I think, for holders of U.S. treasuries.
Yeah.
But now they're starting to sell them.
Yeah.
So that's going to have effects on the U.S. dollar.
Right. So if they're selling them, what does that say about, I guess the overall system, but confidence in the system?
Yeah. I mean, one thing is when you have more supply of something, the price usually goes down.
Yeah.
So, if Japan has been selling their U.S. dollars, again, in an attempt to shore up their currency, right? They'll sell these dollars, so they have U.S. dollars. Now they can buy their yuan, buy their own currency, and stabilize that from free falling, because that's been what's been happening with them. But if everybody's selling U.S. treasuries, the price on those treasuries, the yield is going to go down as well.
Yeah.
So that could be bad news bears. So that's
we're just thoroughly scaring everybody today.
well, it's uncertain times. How about that?
Oh man.
You know what we haven't talked about?
What's that?
Immigration.
Is there a recent announcement that we have to talk about?
Yeah, the former housing minister, since he did such a great job on housing, is now the immigration minister. And everything should be great, right? So basically they've announced that they're going to. I love how they say this. We're going to stabilize the number of new permanent residents to Canada to 500,000 a year by 2025, I think. So it's we're somewhere around 450,000, I think, currently per year. And they're going to stabilize, that's air quotes, anybody who didn't catch the sarcasm, to 500,000 in 2025 per year. So that means every
That's
year
not
going
that many,
forward.
is it?
No, I mean, what's 500,000 people in a population of 40 million? Okay, here, I got another chart up here again for those listening, sorry. But this shows the number of immigrants in Canada from 2000 to 2022. This is a quick one I pulled up off Statista.com. So this must be permanent residents. So there's another segment that we'll talk about in a sec. But we're just talking about permanent residents. So that means, I'm Joe Blow from Czechoslovakia and I want to move to Canada and I get approved. So I get my residence card, and now I can stay in Canada forever. Yeah. I can work here. I'm going to pay taxes here, and that's it. Like I'm here to stay. So, we're looking at from 2000 to now, basically we've had somewhere around 250,000. It's probably been the average, 250,000 permanent residents per year coming into Canada. 2016, we saw that start to climb up a little bit. We had obviously a bit of a decline during COVID because nobody could get in, or it would have gone up.
Yeah.
And 2021 to 2022, that's the last bar in the chart here, is just about at 500,000. And everybody's like, well, don't make such a big stink about this. We're just catching up from COVID, right?
Yeah.
But, and our thought was like, no, we're not. Like, this is a new trend, especially with the number of non-permanent residents, which we'll get to. But this kind of proves that theory that, no, they're boosting this to 500,000 people per year. So
basically doubling the historical average
Yeah.
Of immigration into this country.
Yeah.
In the course of what, like 3 years? Or I guess since COVID, it's really...
Yeah, I mean, that happened 2022, I guess, was the year. Or 2021.
That's profound.
Yeah, it's...
So this is an announcement from a guy who used to be in charge of housing all the people that come to the country.
Think we have a housing shortage. You would think they would be like, oh, we got a housing shortage. We should do something.
Yeah.
And
they did do something. They doubled the population. So they must own houses.
Well, what is it? 50% of the Liberal cabinet own more than one home.
Yeah, rental properties are
right.
Yeah,
which, like, hey, that I'm all in favor of. That's fine, but like, come on, guys, a little bit of transparency here. If you're crying about all this house prices and stuff, but anyways, yeah, just that. So 500,000. So this is in line with their target, I think, of having 100 million by 2100.
Yeah.
Right? This ridiculous thing that they just made up. And that was I can't remember the name of it anymore, but the Century Club or something.
Yeah, initiative or whatever.
Yeah. Which is, so again, there's more to this, right? And what's the reason behind it?
Well, there's this aging population, right? So we need new people to fill up the population that's aging, that's not working anymore. So, yeah, I guess that's part of it, right?
What could we do, Brent?
Have children?
Oh, really? We could have more than... So fertility numbers. It has now dropped in Canada just over a year. It was fertility numbers were 1.55 children per woman in Canada. Is now 1.33 children per woman in Canada. And I know that, well, what about the man? Well, I mean, you need a man and a woman. Like you still do in this day and age. You still need a man and a woman to make another person.
Women transitioned into men, or
maybe. I mean,
or men transitioned.
No, because they can still have babies, right?
The men are diluting the statistics by transitioning into women.
I wonder. Yeah, it could be. I don't think the numbers are that big.
No.
But it's just general fertility dropping, right? I mean, people are waiting till later to have babies and having more fertility issues. But the point is, we're having fewer and fewer children here in Canada. And like, that's not really the government's problem. I don't know. Maybe it is. I don't think it is. I think that's our culture.
Yeah.
And, the culture determines the government. I think, not the other way around.
Yeah.
Government can't really influence culture that much. They have increased the baby bonus, which, like, hey, I'll take it, right? So that, that's cool. But that hasn't really, clearly the fertility rate has dropped.
Yeah, the carrot's not quite tasty enough.
So, yeah, maybe they just need to increase it. So, federal government, if you're listening, increase the baby bonus, please.
Yeah.
But no, it's an interesting... it's interesting, right? We're trying to do all this stuff to kind of fix our nation, and we kind of know some of the answers.
There's some cultural problems that are, and that's where a Christian perspective really informs what's going on here, right?
Yeah.
Because, as Christians, we look at this and we can kind of clearly see, people who don't want to have children, or are choosing not to, for whatever selfish reason, and who are unable to, or
you can't afford to, Brent.
Yeah. Okay. So there's lots of excuses, right?
Well, that's the biggest one, even among Christians. That's what I hear, right? I can't, 2 kids, okay, but that's it would be irresponsible, is what I hear. Actually, they're kind of flipping it around. I think that's gaslighting, isn't it? Irresponsible to have, more than 2 kids, 1 or 2 kids.
Yeah.
Which, no, I don't buy that at all. Right? It's one thing if you can't handle more than a couple kids. Like, I get that argument because I often feel that. Like, why do we have so many kids in this house? Be quiet
until you're 80, and then you're like, "Where are all my kids?"
Well, exactly, right? And what you said, pain is information, right? So there's a lot of information in my house, mainly coming through my eardrums and my feet when I step on Lego or dinky cars. But it's like we have all these problems, right? High rates of anxiety and depression.
It's unbelievable.
All these things, and it's like just we got to turn to God. And I'm not advocating for a theocracy or even necessarily a government that is like a completely Christian government. And like that would be great, but I'm not saying we got to start our own Christian country.
Likely
but
not realistic either.
No, I mean
in this life.
Yeah. Does realism affect your ideals? Probably shouldn't, right? You believe what you should believe, and that's it.
Yeah.
But I mean, it would be great if Canada turned back to God, right? We may not see that happening, but we can advocate for that, and we certainly do it in our own lives. But you want to fix the immigration crisis? Have more babies.
Yeah.
We have all the raw materials we need in Canada to build more families.
And when you have more families and bigger families, you actually have less of a housing problem too, because your population grows, your workforce grows, and the number of housing units required actually decreases.
Yeah. Because
would increase slowly, but you'd have houses with 5 bedrooms filled with 8 people.
Yeah. Yeah, and like your kids can share a room, people. just saying. Well, because that's one of the arguments too against, I can't have more than, like, I've got a 3-bedroom home, I can have 2 children. Like, no, like, fill those suckers up. You can have 3 kids to a room. Easy. And it won't hurt them either. No. But, because what is it? 2.9 people per household. That's sort of the Canadian average.
Right.
Right. And there's lots that have 1, and then there's lots that have more than 1. But increase the average household size.
Yeah, and there's a lot of underused housing in that case, right?
Yeah, tons.
So you have a lot of immigrant families coming over, and they're bigger families, but they're living in 3-bedroom main floor unit in Hamilton Mountain versus
with 6 people.
Someone down the road living in the 2-story house with 1 person.
Yeah, exactly.
Yeah.
So get married, have lots of babies. That's our.
That's the call to action, or.
If I ever run for office, that'll be one of the platforms, right? Let's have more babies. I don't know how well I'm going to do, but
oh man, yeah.
But CMHC has said, like they do their own studies, right? They don't just do mortgage insurance, but they said we need an additional at current rates, and this was a while ago. An additional. Let me see if I can pull this up here. I don't know if I have it. Should have been better prepared.
A large number of houses.
No, here we go. So in order to, now this isn't just to meet demand, but to restore affordability. What does restoring affordability by 2030 look like? They're saying we need, in addition to the houses that are being built, which is about 2 million a year, I think that's probably going to drop significantly for a little while because housing starts are just plummeting.
Yeah.
Because builders can't afford to build. But is $250,000 a month, or about $2 million a year? Is that right? And that's $3 million a year, I think.
Wow.
4 times 3, right? That's about how much we build. So they're saying we need an additional 3.5 million houses by 2030 just to have some affordability. And that's based on sort of a medium immigration or medium population growth estimate. If we go to a higher growth, then that would be just over 4 million additional homes per year by 2030.
Right.
So knowing how difficult it is to build homes in Canada and increase the number, like, we're not going to hit that. right? They're like, there's no chance.
Yeah.
And, these numbers I think are probably low. We've seen other numbers from other people too, saying like, no, we're overestimating the amount of homes that we're building and underestimating what, like what we actually have. So,
that's
so
why,
now we have a high population growth scenario now with that 500,000 permanent residents per year.
And that's why we see this continued push from different levels of government, also on the municipal level as well, for increased density in the existing housing stock that we have. So if a house is a new construction house, it might be able to house 2 families from the get-go, but a lot of the stuff we built 50 years ago, 70 years ago, it can't house as many people. There's only one kitchen in the house or whatever. Right?
Yeah.
So can we use that existing land, that existing housing? And that's what we talk about all the time on the show, right?
Yeah.
The push for more density in housing. And that's a huge opportunity for investors, right? So people can use their existing land if they already own a house and intensify it, or they can buy one, like buy a property and take advantage of some of these trends. And then, not only are you supplying the housing market with much needed housing, but you're also owning it and benefiting from it financially for yourself. So,
what was my, I had another point.
Something about Japan or something.
Yeah, we need immigrants from Japan. No, it's, so yeah, we don't want to go down the route of Japan, right? Because it's interesting. There's limited economic opportunities for especially younger folks. And you see like record numbers of, I can't remember what the word is, but basically young folks who isolate themselves in Japan. Like this is they have a word for it because there's so many of them.
Right.
Where young people would just go like in their room and they don't come out. So they don't work, they don't go to school, they don't do anything. They isolate themselves. Presumably they have the internet and they're playing Fortnite or something. But they just, no interaction with people, and they live with their parents. And even house prices, right? You want to go get a little vacation house in Japan? Like, go ahead, because they're dirt cheap.
Yeah.
Right? You might have to fix it up a little bit, but there's tons of abandoned housing there. Yeah. Anyways, lots of social weird stuff going on there in Japan. There's a different society too, but we talked about permanent residents, 500,000 a year.
Ooh, this is a big one.
Yeah. So, no, and you're talking about governments are now starting to say, hey, we got to do this and that. Like they could have seen this coming for years because people, especially like Tom and Nick Karadza, have been talking about this for years. Like, guys, there's a disconnect between immigration, population growth, especially in the GTA, and housing starts. And 2016 is where you see those numbers. Like we talked about a 250K average per year. 2016 is when that bumped up by about 50 grand per year. So what's 50,000 people? Well, that's like a 20% increase in the actual number. That's a big increase, right? And then now to go to like 500,000 is an astronomical increase. But point is, some people saw this coming.
Yeah.
And we're like, hey, buy real estate Southern Ontario because prices are going to go up. Nobody could have predicted COVID and those prices, but certainly the other indicators, right? But we haven't talked about non-permanent residents.
Yeah.
And, presumably, as in the title non-permanent, they're not going to stay here.
Yeah.
So, what effect do they really have on housing? But as we've seen, most of those are international students.
I've heard them called pre-permanent residents.
that is
a large percentage of them do actually make their home in Canada after they come here for whatever non-permanent activities, mostly students, that they're doing. They become permanent, right? They try and find a job and settle there. I think there is some disgruntled people trying to go back now, but
because they can't afford to live here.
They've been sold a lie.
Yeah, but we've ragged on this in the podcast as well quite a bit if you listen to other episodes. But this is just another pathway to citizenship in Canada.
Yeah.
And so, maybe a number of those are actually genuinely studying here and then going back home, right? So there's a split, right? There's students and there's temporary foreign workers. And the temporary foreign workers indeed are temporary. And so you think of that around here. You have a lot of, like Jamaicans would be one, and I don't know what
Probably
else.
from
But
Mexico and
yeah, Mexico, people working on farms,
yeah,
right? Doing
vineyards and
all this kind of
orchards
in southern Ontario. There's a lot of temporary foreign workers. So they're here like 6 months every year, and then they go back home. And they, I would say they probably don't have much of an effect on the housing market, because especially like I know people who have farms or vineyards, they build housing for these guys, right?
They've come to the same place for 30 years, 40 years. Yeah.
So they've got like barracks or houses or whatever on the property, and that's where the guys stay.
Yeah.
And that's sorted out.
Yeah.
So the much bigger number and the bigger increase that we've seen has been students. And so what was it last year?
750,000, I think.
Yeah. Like, whoa. We're freaking out about 500,000 permanent residents.
Which is crazy to begin with. 500,000 is double what it was.
That's crazy. But now we're talking about like more than doubling that number in temporary.
But what's interesting about this too is that like if you have a baby, obviously they're in your house. And so the population grows naturally over time, and the problems also like can kind of resolve themselves, right? Because that kid's growing up, and that kid turns 12 and then 18, and he's like, you know what, I might as well get a job in construction.
Yeah.
And now he learns how to build a house, and now he's contributing to the economy, and then eventually, he's built 30 houses, and now all of a sudden he moves into one, right?
Yeah.
Whereas when you have immigration increase dramatically over 1 year, and then all the students and whatever, like they come here to study, they're not like contributing massively to the economy. Maybe they get a couple part-time jobs and stuff, but it's like this sudden increase in like mature adults requiring housing now, right?
Yeah.
Individual, like I need my own unit, I need my own kitchen, I need my own bathroom, right? Whereas like the natural way of growth through population, like through birth is a much more organic and kind of easier to deal with.
And you can predict it. You can look at your population trends and be like, oh, you need some more housing. Yeah. Right?
So, but when that goes away and falls off a cliff and it's actually declining, then we have to rely on these kind of like, dramatic, like you turn the switch and here come the people. You turn the switch off.
It doesn't have to be this dramatic.
Yeah. Well, it seems to be that's what they want to do.
Dramatic / traumatic. But yeah, as you said, these non-permanent residents or pre-permanent, like most of them want to move here, and that's the plan, right? And that's if you're doing the student thing, you have options where you can stay for a couple of years after your degree and basically prove that you can be a good citizen or whatever, and then apply for citizenship. There's a path.
Yeah,
you got this 2-year period, or is it 2 or 3 years, and then after that you can apply for permanent residency. So you have to assume that a large number of this 750,000 people per year, I mean, I don't know if that trend is going to continue because nobody really tracks this, right? Like we actually have a number, which is cool, but they I don't know if you recall, this was earlier this year. I think they're like, oh yeah, we miscounted. And I think
I'm not surprised.
It was, and it was somebody. It was either a journalist or a researcher that said, "Hey, I think your numbers are off, man. Like, go look at this." Yeah. And then they actually did, and they're like, "Oh, you're right. We thought we had like 1.1 million." Now, what did they say? We thought we had 750,000 non-permanent residents in Canada. So that's total. As of 2021, I think. And then they had to revise that upward to 1.2 million. So they had no idea how many people actually were there. But if you think that's the total number that was there in 2021, and now all of a sudden we've opened the dam and we're getting that number per year. So just from 2021 to 2022, that number increased from 1.1 million to 2.2 million.
The total.
Total.
Yeah.
Right. And then that number is just going to go up like a ridiculous amount every year.
Yeah.
And some of them, maybe even half of them are going back home. Right. That's still a huge number. Yeah. We're still getting close to 1 million new people in Canada per year.
Yeah. When you say Canada, like I think, this huge country, right? You're like, all these million people in Canada. Yeah.
You think of the map of Canada.
Huge areas where they could go live. Yeah. But no.
That's not where they go. Well, because they're not like bringing roads and sewers with them, right?
Yeah. Through the Canadian Shield in the winter.
Yeah, like go. If that was the case, yeah, like here's an axe, and
Yeah.
here's a square of concrete. You go lay that somewhere, right?
Yeah.
If you want to live here, but that's not.
Trench sewer through Canadian Shield for 5 years, you earn your citizenship. Man,
Well, so we joke about it, but that like.
I think
think about that.
every teenager should probably do that.
Yeah, that would be a
Myself
good one.
included.
Yeah, never mind mandatory military service, mandatory housing service.
Yeah.
But you could tweak immigration.
Oh man, we're gonna have a lot of houses falling over.
Yeah, you need a supervisor. No, but you could tweak immigration to say like, we're gonna look for primarily skilled trades.
Yeah.
Never mind we need doctors and stuff.
Yeah.
But,
Filter people. When
Yeah,
they come
let's
in.
get drywallers. Let's get. People talk about bringing framers in, but like,
Well, like they
there's
bring in
no
surgeons
framers anywhere else in
or
the world.
Either highly qualified people, right?
Yeah.
But they can't practice here. So
Well, that's
so it's like,
another.
you're very highly qualified, but you're not really being used. Yeah.
Yeah,
try
like
and find-
dentists.
Yeah.
I know a number of dentists who are like doing not what they trained for, and
Yeah.
not what they talk about highest
Not
and
what they're
best
good
use
at.
of real estate. Talk
Yeah.
about highest and best use of people.
Yeah.
They should be dentists here.
Yeah.
We need them, right? Anyways, that's my.
All right. How many hours
my
is this? Like people can't listen for that long.
We went on for I went on for quite a while, and you listened, so we should probably cut it off there. But I don't know what is our point. Like, there's a lot of demand. And likely a lot of
Yeah, and there's a lot of
increase in asset
uncertainty.
prices.
So there are people just kind of sitting around waiting to see what will happen. And if you take the short term view of what's going to happen with interest rates, what's going to happen with the market and immigration, all these policies, like that's maybe a 2 to 3 year issue, right?
Yeah.
And maybe a market corrections 4, 5, 6 years. And it could be significant. It could be just a blip on the radar if they step in with more stimulus or whatever, right? But
Yeah.
when you zoom out, which is what we like to do as real estate investors, and look at the overall trends and the behind the scenes kind of like, well, our population's getting older, so therefore we need immigration. Like they could say they want to reduce it significantly, but at a certain point they can't, right? So when you zoom out and you start to see that and you build an investment thesis around, well, this area has a housing constraint. We've had a low supply for so long, and we have increasing population, and we believe both of those kind of trends are going to continue to clash moving forward. That's where we make an investment decision, right? Because you're not making it for a 2-year, 5-year, get rich quick kind of idea. It's we're in this for the next 20, 30 years, and we're going to benefit greatly. And hopefully you have the attitude as well that we're going to be of benefit as well by adding housing units, providing housing, like good quality housing to people. So that would be my takeaway from all of this is don't despair and throw your hands up in the air, but use this kind of to inform your longer term perspective of what's actually happening. So
Yeah, I mean, there's tremendous opportunity.
you
in
sound
the
like
market.
Trump. Tremendous.
Tremendous. Huge opportunity. The best opportunity we've had. Bar none. Under my leadership.
All right. Nobody's voting for Mark.
Okay. Well, we'll wait a few years.
Yeah, maybe the next cycle, maybe the next election cycle, we build up our listener base. Yeah, people can maybe share the podcast with their friends and tell also us what to do better, because we really appreciate the feedback. We've got a number of different comments in the last couple of weeks that really help us to improve our game. So continue to send that feedback in, and thank you, everybody.
Okay, well, until next time, folks.
Steward your wealth wisely. Thanks for listening to this episode of the Two Stewards Show. If you like my voice better, click subscribe.
And if you like my voice better, click share.
If you like both, give us a 5-star rating.
To interact with the show, feel free to reach out at hello@twostewards.ca.
We'll see you in the next episode. In the meantime, steward your wealth wisely.